I'm Nadia Gurwell.
I'm John Goliatino.
I'm Michelle Blanchard. Welcome to 30 Minutes. Welcome to 30 Minutes. I am your host, Michelle Blanchard. My guests today are my two partners at Prosperity LLC in Danbury, Christina Tenig, a certified financial planner, and Jennifer Patton, a certified financial planner and certified long-term care specialist. Christina, Jennifer, welcome to the show again.
Thanks for having us.
Thank you.
Thank you. For the viewers who have not seen you as guests on our show in the past, would you mind telling them a little bit about yourself?
Sure. My name is Christina Tenig. I'm a certified financial planner. Been practicing for in excess of 25 years, so you can put that date on me. Our practice, we started almost 13 years ago.
Yes.
Here in Danbury, after working at another firm, specializes in individual financial planning, focused on achieving people's goals, and doing things very custom. Each person's situation is different, and we like to treat it that way.
Thank you. Jennifer?
Yeah. So as Christina mentioned, I'm also a partner of Prosperity, and she talked a little bit about what we do there. I've been in the financial planning industry, about 18 years. And I live in Bethel with my husband and my daughter, and my dog.
And your horse?
And the horse.
And the pony?
Yes, and the pony.
Yes. So really the purpose of these shows, financial planning shows, is really to try to educate the public. So today we are going to be talking about kind of getting back to basics. And by that I mean basic investment products, going by definitions and how we use some of those investments in our practices as far as the financial planning process. So I thought we would talk a little bit about, we would start with the more conservative investments, which would be a certificate of deposit. So a certificate of deposit is really, you can kind of equate it to a savings account at a bank, or there are other brokerage CDs, which I'm not really going to get into today. But a CD is like a savings account at a local bank, and it provides a fixed rate of interest. So you're earning, you know exactly how much interest you're going to earn on the CD. And they are really considered one of the safest investments because they are FDIC insured. So in addition to CDs, the banks also offer money market funds. And those are also FDIC insured. And oftentimes with a money market fund, the interest rate will be a step higher than a savings account. It is a completely liquid product. So those are really more of the traditional conservative FDIC insured products offered through your local bank. So when we are talking to clients about those particular products and how they fit into their overall financial plan, we kind of look at those products as more of like an emergency fund or short-term savings vehicles for some short-term goals that the client may have. So we will incorporate that in the overall financial plan.
Yeah, and I think it's important to note on the CDs that there's typically a duration, a time period in which you have to hold it, and that ranges from very short, maybe 3 months, out to many years.
Right.
Typically, the longer the duration that you have to hold it, the higher the interest rate that you'll get.
Yes.
But the money markets, as you said, typically do yield a little higher even than the short-term CDs.
Yes.
So sometimes people use those CDs as a means to stage out different goals that they have. So if they know they have some expense coming up a year from now, they might use a year CD, or if it's 2 years from now, go out longer.
And for those clients who really have very little risk tolerance,
Very true.
They don't
Very
want that
true.
fluctuation.
we try to ladder some of those CDs so that when they mature, either they can continue to reinvest, but for safety reasons, for peace of mind reasons, we do use those as well. Yes.
Yes, even though the rates are very low today.
Yes. So along the lines of money market funds, there are money market mutual funds, which are a little bit different than a money market fund offered at the bank. A money market mutual fund was developed really in the 1970s as an alternative for investors who wanted to achieve a higher rate of interest than a CD or a money market at the bank could provide to them. So a money market mutual fund is not FDIC insured. It is SIPC insured, which is Securities Investor Protection Corporation. So there is some protection there. And it's really a pool of investments that you can buy into, and the pool of investments differ. It could be a pool of government securities, municipal securities, tax-free municipal securities, so it does vary. So
Yeah, I mean, money market mutual funds, you know, there are some potential risks. I think it was back in 2008 when there was the banking crisis and that whole market downturn.
Right.
There was some question about whether or not they were going to maintain their $1 share price.
right,
Right.
the NAV.
So, you know, because they're invested in sometimes corporate securities, corporate bonds and things like that, there is the possibility, there could be some price fluctuation. It's so rare to happen, but
Yeah,
it can.
that would be an
Right.
extreme circumstance,
would be
which
extreme.
2008 was. For
Yeah,
sure.
well, it was extreme, and I don't know that any that did
I was
actually.
just-
I don't think
Yeah.
so.
But there
I was
was
just
a
going
lot
to
of discussion about it, but I don't think
Right.
any did. But it
Right.
has happened.
Right.
It has happened
Right.
in the history of money market mutual funds.
Right. So for those particular clients who are invested in money market mutual funds, again, we kind of, if we're not using the money market funds in a bank or a CD, we will, the next alternative really is a money market mutual fund
Right.
to accomplish some of those shorter term conservative goals.
Right.
So now that we've talked about more of the conservative investment products, let's move on to individual stocks.
Okay, yeah. Individual stocks, definitely more risk. So, you know, when you buy a stock, you're buying a piece of ownership of the company. And if that company doesn't do well, the share price can lose value. Or if it does well, it can go up. So there are a lot of different uses for investing monies. You know, most people want to invest in stocks to make gain. You know, so they buy a share at $10 a share and it goes to $12 a share. They've made a 20% increase in the value of their investment. So a lot of people do that, but a lot of people also invest in stocks to get the dividends.
Yes.
You know, so for people who are in retirement or maybe nearing retirement, they want to build a portfolio of investments that is going to produce income for them in retirement, they might go with some dividend stocks. Typically utility stocks pay nice dividends. Consumer staples stocks usually pay nice dividends. It's rare when you find a company cutting a dividend, so it is a pretty consistent income stream when you do that. And when you do own a stock that pays a dividend, the share price can go up, down, or sideways. You're still going to get the same dividend cents per share than you would if it was the stock price was higher or lower.
Right.
Right.
And that was important in the downturn of 2007, 2008, 2009, and having conversations with our clients because they would see the day-to-day volatility in the market, and for those clients who are retired and who depended on that dividend income, it was important to redirect the focus back to some of those dividend producing stocks or bonds, which we'll get
Right.
into in a minute, to really reinforce the fact that those dividends are still getting paid regardless of the share price of the individual stock.
Right.
Yes, and when we talk to our clients, and I said earlier about we customize our financial plans for our clients, you know, if one client needs income, their portfolio is going to look different than a client who doesn't need income.
Right.
And it doesn't mean that any one of those investments are bad, they're just not appropriate for a particular person's situation.
Absolutely, yes. So let's talk a little bit about individual bonds, and the stock conversation and the bond conversation will then kind of redirect to Jennifer, which will tie it all into when we talk about mutual funds. So an individual bond is essentially a debt obligation, an IOU, if you will. So when you buy an individual bond, you're letting the corporation who is offering the bond use your money in exchange for a return of interest and principal when you sell the bond. So with individual bonds, they carry risk based on the assessment of the bond. So there is credit rating risk associated with the bond. So based on the risk of the company, their claims paying ability, it will depend on the risk or the credit rating that's tied to the individual bond.
Right.
Right.
Sometimes I explain it too for clients that, if you're looking to purchase a car and you're looking to finance it, the lender's going to check your credit rating. And if you have a low credit rating, you're a higher risk, so you're going to pay a higher interest rate. So just like if you're looking to purchase a bond or loan money to a company, you're going to check out their financial health, and based on their credit rating, you'll either be assuming a higher or lower interest rate.
Absolutely, yes, that's a great explanation.
Yeah, and I think it's important to note that when you get a higher rate of interest on a bond from a company, it does mean that there is more risk associated with it.
Right.
So if you do not wait until maturity, when you go to sell it, the price could be lower than the face value. It could be higher, it could be lower. And certainly if there is a really low rating, it means that the company is in some financial distress. It could potentially, if it filed for bankruptcy, you may not get all of your money back.
Right.
Although bondholders are in line up front in terms of getting monies back. In that situation when we talked about stocks, the stockholder would get nothing.
Right. So there are different types of bonds. One that we're going to talk about are corporate bonds. So there are corporate bonds, which are debt issued by private and public corporations. So those bonds are investment grade and non-investment grade bonds. So getting back to your comment, Christina, about the risk of those bonds, investment grade bonds carry a level of risk that is not as aggressive as non-investment grade bonds.
Correct.
So an investment grade bond would have an interest rate or a dividend rate that is
An investment grade would be a little bit lower because
A
you're
little
not
bit lower,
taking
yeah.
quite as much risk.
yes, absolutely.
Yeah.
Yeah, and a lot of times when you talk below investment grade, it's what a lot of people call junk bonds. And that term, kind of makes them seem like they're really, really bad. They're not always.
Right.
And they can be an appropriate investment vehicle for people in small pieces and small doses. They can be appropriate for a lot of people who are looking for income, and they do have that higher yield.
Right, absolutely. So Jennifer, would you mind talking about mutual funds and how bonds and stocks tie into mutual fund investments?
Sure, I'd be happy to. So Christina explained what an individual stock is, you explained what an individual bond is. So with those, you're just making one purchase and you're owning one security. With a mutual fund, you make one purchase of that mutual fund, but you own a basket of various securities. So it could be based on the investment objective of the mutual fund. It could be hundreds of different stocks, or it could be bonds, or it could be a mix, again, depending on the objective. And diving down even further, let's assume it's just a stock mutual fund. It could have a focus of those growth stocks Christina was talking about, or dividends. So maybe everything in that portfolio in that mutual fund portfolio is designed to pay a dividend. Sometimes they're international, there's many different styles, and sometimes they're sector related. So they could be focused on healthcare or on industrials. But with that one purchase, it's nice you get a bunch of different companies, so that if something negative should happen to one of those companies, you've got a cushion there, because you're not just focused on that one company, but more likely 50 or, like I said, 100 companies.
Right.
There's usually a manager associated or a management team associated with a lot of mutual funds, so there's an extra expense there, but that manager or management team is deciding what they want to own and what they don't want to own.
And you're adding a level of diversification for
Yes.
clients to
Exactly.
kind of spread out the risk.
And I think that makes a lot of sense when you have somebody who's starting out, so that they can get diversification across various different sectors. So if you own a mutual fund, you might own some consumer staples stocks, you might own some technology stocks, you might own some healthcare stocks, all in the same mutual fund, that you might not be able to get that type of diversification when you're first starting out building a nest egg.
Right.
You know, that's what I think a lot of 401ks, most 401ks use mutual funds because it gives their employees the opportunity to diversify without having to say, gee, is Apple a good buy now, or is IBM a good buy now?
Right.
Exactly. And within the 401ks, there's an increasing number of target date mutual funds.
Yes.
So this way it makes it, I think, even perhaps a little bit easier for some of those investors trying to save for retirement. So if you're looking to retire at a certain date, you can actually pick a mutual fund that matches closely with that date. And then if you are, 15 years away from retirement, it's going to, that mutual fund mix of investments is going to be more aggressive because you've got some time on your side.
Right.
And then as you get closer to that target date of your retirement, it's going to gradually get more conservative for you. So you always want to have a sense of what's going on in there, but it is trying to, trying to help you align with your goals.
Right. And what we see sometimes too, especially with 401ks, the participants, they kind of put their money in every week or every 2 weeks, and they don't really check into it or
Right.
revisit the allocation as much as I feel they should anyway.
But you know what? Sometimes that's not such a bad thing.
Exactly.
Because some people who obsess over the ups and downs of the market, they get too nervous and they have a tendency to pull their money out.
Right, overreact.
And we know that you can't time the market. And in the case of those 401ks, when you use something like a target date fund that Jen was talking about, which is a combination of equities and fixed income typically, they're creating a balance for you within the mutual fund so that you can, kind of take your eye off the ball. And
Right.
like they should be rebalancing that as you get closer to your target date.
Absolutely.
So,
Right.
that can, you're right. People should look at and should know what's going on and should know if what they have is appropriate. We've run across that a few times where we've seen 401ks where people have something that in some cases just ballooned in value so much that they didn't realize how much they were overweighted.
Right.
Absolutely, yes. And I think that's why we're seeing an increase in the target date retirement funds, both from a fiduciary liability issue for the
Yes.
plan sponsor to provide those investments in the plan to make sure that the participants have a diversified offering to choose
Right.
from.
Yeah, I know.
I agree.
It seems like a long time ago, but only yesterday when there was the whole Enron debacle.
Right.
And a lot of people back then had their 401k money in the company stock. Now that's going forward has become very restricted. A lot of companies don't allow you to do that.
Right.
Put all of your eggs in that basket because of the risk associated with it. So it is nice to have a diversified product that you can use.
Yes,
Right.
absolutely. So let's talk a little bit about 529 plans. That ties into the use of mutual funds.
Yes, yeah. 529 plans are essentially mutual funds, but a 529 plan is really comes out of the IRS code that allows you to save tax deferred for higher education expenses. So it was created such that you can put money in after tax money. In some states, you will get a tax deduction. In Connecticut, you can get up to $5,000 of a state, not federal, tax deduction for each taxpayer. So if you're married filing jointly, you could get up to a $10,000 state tax deduction. So you put the money in, you get the state tax deduction. The money is in a mutual fund. They have the target type funds if you want to use that, or you can
The
create your own
age-based.
age-based. You can create your own portfolio. The money grows tax deferred, much like when you have money in an IRA or a 401k. And then if you take the funds out for qualified higher education expenses, and I'm going to make an exception to that, but for qualified higher education expenses, then the money comes out tax-free. None of that gain is taxed,
Right.
which is great. So it's a way to help you reduce the cost of investing towards your children's education, or children, grandchildren, or whoever it is that you're saving for. Under the new tax law that was just passed at the end of last year, they did make a slight change to the 529 plan, where now you are allowed to use up to $10,000 a year for private school K through 12.
Right.
So that's interesting.
And homeschooling too.
And
which is a huge-
homeschooling. And homeschooling.
Yes.
But if you're homeschooling, do you pay yourself?
That's a good question.
You should get paid, but.
And if your child receives a scholarship?
And if your child receives a scholarship, good point, Jen, to bring that up. So if your child receives a scholarship, you can withdraw the funds equivalent to the scholarship out of the 529, so they're not locked in there. And if you should end up with money behind in the 529 plan after the child is done with schooling, those funds can be transferred to an immediate relative of the original beneficiary. So if it was my son, I could transfer it to his brother, or if he becomes married and has children, to his children. So there's some limitations to how far out you can go.
I was going to ask, how far out for the viewers?
I think it's first cousins.
Okay.
I think so. You know, like when you go sideways, I think it's first cousins, but I think you can go up and down as far as you want.
Right, so if I wanted to go back to school after my children are done, and we haven't depleted the 529 plan,
Yes, you can transfer it to
I can
yourself.
transfer it back to
Yes.
myself.
And if worst case scenario, you have to take the money out, not for college expenses or K through 12 now, you would take it out, you pay taxes on the gain, and there would be a 10% penalty. Very much like a premature IRA withdrawal.
Right, right. Good. Okay, so we've talked about 529 plans. Let's talk about real estate investment trusts.
Real estate investment trust.
We, in our practice, we really don't utilize too many REITs. We use more mutual funds that incorporate
To get that
REITs
REIT exposure.
Yes.
in their portfolio. But let's talk a little bit about REITs.
Yes. And one of the things when you started out today, you said that we're going to talk about the basics of investing.
Yes.
I think that sometimes people try to make it too complicated. It doesn't need to be that complicated. You know, so most of our most successful clients their investment success is because they just plugged away at it. You know, and they didn't try to get crazy. They're not trading cryptocurrency. They're not buying limited partnerships. They're not doing crazy tax
Hedge
strategies.
funds.
Yeah, they're investing systematically, you know, living within their means, conservatively, sticking to it. But REITs can be, you know, and REITs sometimes we limit people's exposure to real estate investing because many people own a home, and sometimes that's their biggest exposure to real estate. So if you were highly exposed to real estate investment trusts and you owned your own home, and we hit 2007, 8, 9, you would have been very sorry. You know, so again, a diversification, you have to be conscious of someone's entire net worth when you're investing. When you're picking something for yourself, for us as professionals picking for them. So if they have a large value in their home, or they own a rental property or a business property or something, you may want to be cautious about that. But real estate investment trust mutual funds, the real estate investment trust typically will own commercial properties for income. So it could be shopping malls, it could be nursing homes, it could be
Public storage.
Public storage, that's the one I was thinking about because there are a lot of those. But there's a lot of different types of real estate investing. But a lot of it is centered more on commercial and income producing type vehicles.
Yes, yes. And we do incorporate, for those clients who are a little more, I think, aggressive, not aggressive, but who can take on a little more risk, we do incorporate some of those sector funds in our clients' portfolios.
Yes.
And one of those would be a real estate.
Yes.
So we do use some of those in our practice.
Yes, yeah, and those are great drivers and small pieces. We've always used them. So if you wanted to have a core portfolio of equities and fixed income, you know, on the equity side, you're going to have some large caps, small caps, mid caps, and then sometimes we drive in some of those sectors. We might use the healthcare sector or the real estate sector, or you know, emerging markets, depending on where we are in our economy.
Yes, yes. So let's talk a little bit about the use of annuities. Now, some people really hate annuities, and some people really love annuities.
So annuities, we could spend an entire
Yeah,
half hour talking
exactly.
about.
Yeah,
Yes, just
and
the
to
main-
say that, you know,
Yeah.
Michelle was kind of tongue-in-cheek, but there's thousands of different kinds of annuities. So
Yeah.
when you say you like them or don't like them, you really have got to drill down to the particular product to see what's suitable for you.
Yeah, you really do. And I just some broad categories. There are immediate annuities and deferred annuities.
Yes.
So an annuity is an insurance product, so it's a contract between you and the insurance company. An immediate annuity is you say to the insurance company, "Here's my money," and the insurance company immediately starts paying you a monthly stream of income.
Right,
A lot of people don't use those anymore.
right,
Those
because
are
you're
the traditional
giving up
type.
control over that,
You
that sum
typically
of
give
money.
up control of that money.
Yes, in exchange for a fixed period payment.
Yeah, like a pension, almost like a pension payment. More people are using deferred annuities where you put the money in and the money is invested based on what you want or what somebody has advised you to do. They're mutual fund-like. They're not technically mutual funds, but they're mutual fund-like. They're pools of securities. And it's deferred because you can defer the payments for forever. You don't have to. You could just use it as an investment vehicle without, taking any payments eventually.
And some people use a tax-deferred annuity to save above and beyond their retirement, their 401k, their 403b, or IRA
True.
contributions,
Yes.
as a way to save for retirement and get the tax deferral.
Like the 529.
Right.
You put the money in and it grows
Right.
tax deferred in this case, and when you take it out, you do pay taxes on the earnings.
Right.
And then within the annuities, you have fixed annuities, you have variable annuities, fixed being more like a CD, variable being more like mutual fund investing. So there's a lot of flavors, there's a lot of cost associated with it. It's not something I think you jump into lightly, but I own some myself in my retirement account, because they do, a lot of people today won't have a pension stream, a pension income, and they can create that for you down the road, and that's what I was looking for.
Right. And one of the benefits of owning a variable annuity is the death. They do provide a death benefit. It could be a basic death benefit or an enhanced death benefit, but let's just stick to the basic death benefit today.
Yeah. So the basic death benefit is typically whatever you put in is guaranteed to come back to your heirs minus any withdrawals. So if you bought an annuity in 2007, a variable annuity, and you put in $50,000 and it went down to $30,000, your heirs would still get the $50,000. So there is that guarantee. Many of them will step up every year on the anniversary, sometimes some of them more often than that. So if the market value is higher in any given anniversary year, they'll step the death benefit up to that. And it is, there are a lot of different features to them that are good, but again, you have to figure out which ones are the ones you need.
Right. And that fit into your overall financial plan.
Exactly.
Right.
Yes. Yes. So we have 1 minute left.
Okay.
So let's talk a little bit about international investing, just a small little piece.
Did you do that, Jen?
Yeah. Well, international investing, again, as we were talking about diversification, it can be really important because companies based in the United States, can be successful or not successful based on the economy. International gives you greater exposure, gives you global exposure, and again, provides that diversification. So in years when the U.S. is not doing well, international may be.
Right, right. So for those viewers who enjoy our conversation, our banter, please feel free to email me or call the office if you have any requests for financial planning topics. Thank you again for joining us, and I will see you next time. Thank you.